Mr. Scott Olson, here
Good
you are
morning.
again.
Good morning. Great to be back on.
It's great to see you, sir. Executive Director at the CHLA, Community Homelenders of America, a very important dude in mortgage. Have you ever been called a dude before?
No. Do I need a hat? I was in Big Sky, Montana 2 weeks ago. I should have brought a cowboy hat. And I
How
could
was it? How was Big Sky?
It's amazing. I recommend going there.
Had you been before?
No. Friend. We've traveled with my family every summer, my kids and their significant others, and we take a trip out west. Last year was Banff, and had a friend out there, and they recommended Big Sky, so we said, okay, we'll give it a try.
What was the best part about it?
Just I guess the yurt. We took a truck up to the top of a mountain, and they did a little fancy dinner, and we had great views, and the food was amazing. But the hiking, I guess.
Excellent. All right. Well, it's great to see you. It's been a while.
It has. Too long.
We have a lot to talk about. You're a busy man at CHLA, of course. CHLA.
Well, no, it's a busy time. There's a lot going on.
Yeah. So you all are one of the bigger trade groups in the mortgage industry. So we'll throw that qualifier in there. And there's a lot to talk about here. You know, we're going to get into condos and we're going to talk about Ginnie Mae and liquidity because there's some concerns there and a bunch of other things, you know, breaking through the noise. And lastly, we are going to talk about the CFPB, but I have my own little list. That's your list. I have my list.
Okay. All right.
All right. So I've got my own little list, and of course, I go first because I'm the host.
Exactly. You drive the agenda. You drive the agenda.
I'm driving the bus here. Grade this administration so far on housing.
B plus, A minus. I think the good news is we've been stuck, I think, for many, many years in this bipartisan quagmire where both sides had sort of created a standoff, and Congress was split a lot of the time. And so we weren't seeing action, even the low hanging fruit. And, I'm not saying that I think everything the Trump administration has done has been good, but they've been very receptive on a bunch of things. They instructed Fannie and Freddie to buy mortgages to help try bring down rates. We've been pushing for that. They've made reforms to the CFPB, regulatory process. So they've I could go on, but they've been.
That seems like an aggressive grade.
Why do you say that?
I mean, A minus, B plus. Look, I never reached those grades in school. So but I'm guessing that's in the 90% range. So, I mean, that leaves just a little bit of window that they could be better. And well,
I've never graded an administration less than a B anyway. So you understand in my position, we're always going to look at things from a slightly rose colored thing.
All right. Well, how did
I'm on the air, Greg.
I need a comp, Scott. How do you grade the Biden administration, the one that's already done?
How
would you grade that?
I'd say B minus. I'm still in the B area. The problem, I think that the problem was that not what Joe Biden did per se. I don't want to get into that, but that he didn't really have a housing background. He didn't bring a bunch of people with him that had been longstanding people in housing, and I think that was his interests were elsewhere, like foreign affairs and things like that. So.
Well, who in this administration knows housing? Because it's funny you should say that. This is one of the questions I had on my list. So you're scratching my itch here, because I don't know. Does Director Pulte? I mean, he knows building, but does he know the mortgage business? Like, one of my questions is just overall: is there enough mortgage acumen in Capitol Hill? And if so, who is it? Elizabeth Warren?
So I guess I would start out by saying that everyone wants to talk about the big showy picture stuff. And I would say there's a lot of very competent people in the agencies, like Joe Gormley at Ginnie Mae is outstanding. Matt Jones is over at FHA. These matter. I think FHFA. It's yes, Pulte is in charge, but it's a collaborative process where you have Fannie Mae, Freddie Mac, senior staff that's been around for a while. It's a continuation. So I think the CFPB has been the most difficult to follow because they were run by the head of OMB for a while, and now they're trying to get a permanent director. And so, but they clearly understand the issue. So yeah, I mean, I think when it comes to the people in the trenches at the key agencies for our members, I think there's a lot of very qualified people.
You talked about the CFPB. My understanding is no enforcement actions in 2026. Is that your understanding as well?
Well, I don't know whether there's none. There's clearly, it's been a different perspective. I think that that's one half of the equation, which is that they obviously, I mean, I think they're moving towards a lot of the things that we've been arguing for years, which is, number one, it shouldn't be based on did you ticky-tack violate some rule, but whether there's consumer harm. Number two, there shouldn't be regulation by enforcement. Number three, some of these rules that the Biden administration, one of the reasons I gave them a B-, they were doing some rules that were absolutely redundant for IMBs. They took those out. So, but obviously it doesn't mean that this goes away. It just shifts to the states.
Yeah. I mean, I think when you compare Biden to this administration, the bar was pretty low. Having said that, there have been some significant things that have happened. I look at how they attacked FICO, and they insisted on Pulte insisted on competition there with VantageScore, which is gaining adoption.
Yep,
that's good. That's super positive. I guess where I get stuck, and maybe you can clear my head on this, is the levers that they could be pulling in terms of affordability that they're not. More specifically, G fees and really LLPAs.
Yeah,
that's something that they could do. They could just do a carve out for first-time home buyers and waive LLPAs, for instance. Do something with them. Even give a small little window where you do that for 6 months and then we measure, like something like that. And I understand, my opinion is that they didn't do that. They didn't do that when Barry Habib was leaning in on it as a member of Fannie Mae. He's on the board, because they were really considering strongly taking the agencies out of conservatorship. Well, now we're 2 years in. We're probably going to have Democratic House. So it doesn't look like that's going to happen. So if that's not going to happen, if they're not coming out, and they don't necessarily have to justify them coming out by ringing the register and showing this big number that brings in a nice, attractive amount of money from the public markets, then why not do that? This is where I wonder if they know what they're doing, because if they really want housing to get behind them, that's something that they can do, Scott, right away, that will make the president look like an absolute champion for those that are on the outside looking in.
I totally agree. I think someone handed you our hymnal. I mean, we were fighting early last year for cutting LLPAs on manufactured home loans, on condos, and on high cost loans. And we really made a big splash of that with our Gen Z report a couple months ago, which we featured when we rolled it out. That, for the high cost loans, it's, they are not because they're risky. They're higher LLPAs because some people in Washington don't want to see loans in higher cost areas. Well, it's ridiculous. I pulled up a $720,000 home in like Kansas or Wisconsin, I think it was, in rural Wisconsin. 750,000, 5,000 square feet, 6 bedrooms, whatever. So that's okay. But then I pulled one in, I think it was Calabasas, California, in the Valley, 1,300 square feet, not even a starter home, probably needed some work. And that was $850. And that's a starter home. And so there's just no reason in these high cost areas that we should be discriminating against these loans. And so we'd like to see that fixed. And so yeah, they could do that. And maybe, I think you may be onto something. It factors into the taking them public. But, sometimes if you do this stuff, you can make a few more loans and you actually might make more money.
Well, I mean, the biggest issue facing both parties is affordability. Things are just
right.
out of control, right? And housing is front and center in that. I mean, there's obviously gas and groceries and insurance, and there's a lot of things that are pushing the consumer. But when you look and, I'm reading here that Fannie and Freddie Mac reported strong financial results for the second quarter of 2026.
There you go.
Fannie posted net income of $4 billion, while Freddie reported net income of $3.8 billion. So these are cash cows. There's certainly a lot of room to move. I don't think they were put in place to be these cash cows. They were put in place to serve first-time home buyers and to be able to help, facilitate a healthy housing market. And so this is why I come back to the initial question that I started with. Are there enough people in Washington that understand that doing something like this, even a small win, not permanent, but the impact that would make in helping the Republicans in November?
See, you're spot on, Greg. I don't think it's a matter of lack of understanding. I think it's here's the, and I got to be careful what I say here. Look, everyone in the mortgage industry, lenders, title companies, everyone, all loans are equal. Okay, in a sense that you make, the profits. Actually, you make more on, existing existing higher cost loans, but what we tried to do in May was to focus on the real issue, which is first-time home buyers, Gen Z, the incredible challenges that now what the realtor said, the average first-time home buyer is now like 40. That's unacceptable. Okay. And so the focus shouldn't be that all loans are created equal. The focus should be, like you said, that there's a higher priority for getting first-time home buyers in the market, particularly people in their 20s and 30s. That's why we've been focused on condos. Those are entry-level homes in a lot of markets. You live locally. A lot of young people, what can they afford? They can't afford a freestanding home in the DC area. They can afford a condo. Number two, manufactured homes in rural areas. That's the most affordable product. And then in these high cost areas, getting Fannie and Freddie back in the game. So I think that's what's needed. That's what we try to do in May. We need more people talking like you're talking, to say the focus can't just be on mortgages generically. It should be on our target audience of trying to turn this around and get this generation back into home ownership.
Scott, one thing that I want to point out, which I stumbled upon, and you might stumble upon it now here, the 40-year first-time buyer age came from NAR, National Association of Realtors. I wrote about this on my LinkedIn. I believe it was a mail-in survey of like 1,000 people or 5,000 people. It was something negligible. It was, and then the press picked it up and ran with it to say that the average age is 40. Now, ICE and other people have come out and said, actually, the average age of the first-time home buyer is 32, 33. So,
Greg, it doesn't matter. It's higher than it was a generation ago. No one disputes that, right?
Yeah. So my other question is, because how long have you been involved in housing? How many years?
Just 30.
Yeah. So how does this moment compare to other moments where housing had its fair share of challenges?
Oh, I'd say it's average. I mean, we've been through some really difficult times. Obviously, 2008 was horrendous. Going back, I wasn't around, but we went through the S&L crisis in the 80s. We don't have crises along those lines, which is good. So I think we just have to, blocking and tackling, get down to basics and talk is cheap, but these programs and the things we do make an impact. I mean, the other thing that we did in our Gen Z report, there's trillions of dollars in assets out there, okay, that could be used for down payments. But because of IRA rules and capital gains rules, people can't access them. If you start working at 21 and build up $100,000 IRA nest egg by the time you're 30, then you turn around and say, oh, I just figured out I want to buy a home. You pay a huge penalty to access those funds. We have proposals to make the rules better for getting loans from your IRA, and then you pay it back and you move on and reinvest it in stocks. So, you have to do the heavy lifting. You have to do the hard work to do a double here, a single there, a triple there. And all of a sudden, whatever the age is, if it's 32, well, we can get it down to 30 or something.
So we mentioned the 40-year-old benchmark, and I agree and appreciate you're saying it doesn't really matter, because it's so hard to get into a home right now because of so many crosswinds. That's for sure. Scott, I want to ask you about the administration one more time, because you said we need more people like me, you just said, to speak out. The question is, if we could get a symphony of people, are they listening?
Yeah. I think so. I think that every administration responds to, number one, what are people talking about? Why work on stuff that no one's saying is important? So just setting the agenda, and then two, setting priorities. I mean, that's what we're at CHLA. We don't believe in writing every last letter and weighing in on every last issue. We sit down every week with our members, have a call, and they talk about what's bothering them the most, and we filter that in and set our priorities to focus on trying to move the dial in the areas that are going to make the biggest impact for our members.
Oh, and you also bring your members right into the hallways where decision and policy is made. I am a member of CHLA, Community Home Lenders of America, and very much appreciated being walked right into Ginnie Mae. I think we talked to Greg Keith, who's very high up in the food chain at Ginnie Mae. This was last year. Also had a meeting with FHFA, so I appreciate that. And at a fraction of what it costs at some other trade associations. So you guys are doing great work. You're making a tremendous impact. What are you working on right now?
Thank you.
What's high on the docket at CHLA?
Funny you should ask, because in early September, we're looking at unveiling a report, a white paper on Ginnie Mae. You may remember in 2000, the world went to hell in a handbasket with COVID. And so, issuers and Congress said to borrowers, oh, you don't have to pay your mortgage, which was an interesting perspective. And so issuers were under stress from having to advance funds. I mean, remember, we asked issuers to be a banker, even though they're a non-bank, to these borrowers. And so fortunately, it was a strong environment for IMBs because rates were low and there was a lot of refi business. But what happens the next time that we have a spike in defaults, and issuers have to go back to their lenders and get more liquidity for that? So we're working on an expanded proposal for a standby liquidity facility. In other words, don't wait until the next crisis. Set it ahead of time. Build confidence in the system. It reduces risk to Ginnie. It reduces risk to bankers. It reduces risk to IMB, Ginnie Mae issuers. So we're coming out with that. Again, not something that people, and we're also going to have a lot in there about what Ginnie Mae is and how they operate, because I think most people in Washington, in the policy world, that's one of the areas of least understanding.
Yeah. So let me just throw a broad blanket on this from the lens of anyone out there. I would say the majority of people probably think, all right, Fannie, Freddie, Ginnie, government entities, they're probably all equally collateralized and, all there. Getting choked up here. Maybe I'm about to get emotional. I just have a little phlegm going on, Scott. So please forgive me. I'm gonna do a one throat clear here.
Okay.
So
Pause.
No pause. I want to be as real as my audience wants me to be real, Scott. So I'm just going to give it one, because otherwise, you get in these conversations with people and like, and then every 15 to 20 seconds they do that. Why not just one big clear? I'm going to give it a clear. You ready?
Yep.
You see that?
Good.
How much better does my voice sound now?
You sound like an announcer.
Oh, thank you very much. All right. So anyway, broad blanket. Why is Ginnie so much different in terms of being insulated and capitalized than Fannie and Freddie?
So it's not even apples and oranges. It's like avocados and steak. I don't know. Fannie and Freddie they're in a lot of ways an insurance company. They buy huge slogs of mortgage loans and they have the risk. So in 2008, when prices went down and mortgages went to hell in a handbasket, they lost money. Okay. How much money do you think Ginnie Mae lost in 2008 and 2009? The answer is they made money because they don't buy mortgages. They securitize FHA loans, which are already guarantees. They securitize VA loans, which are already guaranteed. They securitize RHS loans. So the risk is exceedingly low for them. They've made money every year for the last 20 years, except 1 year when they lost $30 million or something like that. So the issue is they're there for a purpose. They're there to facilitate a broad market of competitors. In other words, that's why we exist as an organization. We represent primarily small and mid-sized IMBs. And we think that consumers benefit by having a lot of us. And one of the ways, like in 2000, honestly, a lot of the aggregators, because of forbearance and other things, some of them dropped out for a while. Some of them had really poor pricing, but it was your firm and others that were in the market, doing directly through Ginnie Mae that kept a competitive market. And that's why we're focusing on this issue.
I don't know that I fully understand that answer.
Well,
I mean, if it worked, in other words, you're saying there's a need to set up a backstop just in case, so you don't have to panic. I get that. That makes great sense. But then in the other breath, you say that they've only lost money once over the last 30 years or so. So what's broken? That's a pretty good track record. 29 out of 30 is pretty good.
Because they're making money is not the same as having a broad base of issuers. And if they decide to be, excessively conservative and crack down on issuers when you get to that market, then you're going to have, people out of the market.
All right. That's a great answer. The other side of this coin is, why now? Are you fearful? Do you think, based on the history of you knowing the market and trajectory and energy prices and recessions and all that stuff, that we could be heading to a moment where we're going to need to make sure that's in place?
I think it's important enough to try to push for that. I mean, we're not asking them to put it in place. We're asking them to do some real work. In other words, figure out who should fund it. Should it be the Federal Home Loan Bank lending to banks, or should it be the Federal Reserve?
But do you think we're heading towards another crisis? Do you think?
I have no idea.
Well, I do. I do.
Well, maybe you think, but here's the point. I was there. I worked on the Financial Services Committee during 2008, and the mortgage business went to hell in a handbasket. And we came up with huge programs like HAMP and HARP in 20 days. Okay. And could we have done better? Of course we could have, because we waited until there was a crisis to figure out how to deal with what a crisis would look like. So let's do some thinking ahead of time. So the next crisis, which might not be for 20 years, or it might be next year, who knows? So we're ready, and that we, that's our point.
Something has to give. Something has to give. Meaning you've got hot inflation, consumer sentiment's terrible, debt is awful, delinquencies are going up, gas prices are up. Like, if something has got to break. It will break. Something will break. It just is factual. Never in the history of mankind has something not broken. So what is it going to be? And for me, I think it's going to be the consumer is just going to absolutely capitulate. And it's going to make it harder to make mortgage payments. And when you don't make mortgage payments, defaults go up, and eventually you typically head into a recession. Rates go down. So I mean, this, right? And that's where. So I think that I appreciate the work that you're doing. I'm just one opinion, obviously, but I appreciate the work you're doing, because I don't know how it's going to manifest itself, but it will be good if we get into a mode where that next crisis is closer than we think, and we have a facility in place. So thank you for the work that you're doing to that end. Even though you don't necessarily agree with my thesis, although I'll ask you, what do you think? What do you think will break? I mean, is it going to be inflation? Is it going to be wages? Is it going to be house prices? Like what of the options there are? Did you have any kind of a gut feel?
Well, I think that, I mean, I don't know. I'm just drawing on experience. I remember in the 90s, in the 80s and 90s, I mean, going through the cycle, prices went up and up and up, and like in here, and then all of a sudden in 88, here in Washington, they stopped. In other words, and then 10 years later, the prices were the same or lower, and that's how they adjusted. So that's kind of my best guess. I don't really
Got
understand
it.
stuff.
All right.
That things are going to be soft for an extended period of time.
Yeah. What's it costing to fill up your tank these days?
$4.
Oh, I see.
No, $4 a gallon. Sorry.
I was going to say $4. Man, were you riding a tricycle to work? What's going on here?
Well, it only costs $12. I wait until the thing's this far above E, and then I put in 3 gallons, and then 2 hours.
Have you ever run out of gas?
Just in the mountains of Arizona, driving across country from LA to Washington. It was not a good time. This was like
what happened? Walk us through it.
This was before cell phones. A trucker gave us a ride, and then a trucker drove us back with a gas can. So I learned my lesson. I don't think I've run out of gas since then. But.
I've run out of gas once. Yeah, it's the worst feeling. Because you always assume, like, you get the car, they're like, oh yeah, when it's empty, it's not really empty. There's this reserve tank, so you always think that you can kind of straddle that, and it's the worst. The only thing worse than that is when that deflated tire indicator comes on your dashboard.
Oh, yeah,
that sucks.
Yeah,
you got to get out. You got to see how fast is it deflating. I carry an air pump in my truck now, just in case.
Greg, has anyone in your audience not run out of gas once in their life? I mean,
that's a great question. I'm going to bring this up on No Surrender today. That's a really good one. Thank you for that. You know what else I'm going to bring up on No Surrender?
Okay.
I'm like thinking of these quirky things. This is totally one-off. I'm going to catch you off guard. If you're in a grocery market,
you're
in a grocery store, and you walk up to a bag of grapes, is it okay to stick your hand in and grab a grape out and test it out to see if it has the level of sweetness that you need?
Yeah, as long as you leave 2 pennies on the.
I'm serious, because I do that. I take a grape out of every bag. Do you?
No.
Are you going to deny that you've never taken a grape out?
No, I buy the raspberries in the little boxes, and so I just look at them. That's all. I'm not a big grape person.
What about cherries? Same thing.
I'm not a big grape. I'm cantaloupe.
All right, apples. Do you ever pick up the apples and like push your thumb into it to see if there are any soft spots?
I'm gonna have to plead the fifth here on that one.
Yeah. Okay. Yeah, I thought so. All right. So there's also this topic you wanted to talk about: break through the noise.
Yeah.
What is that?
So all of your listeners, you're in the mortgage business. And so one of the things I've learned over 30 years is everyone sort of thinks that that's what people are focused on, what they do. But in fact, Washington is this just cauldron of noise where you've got interests representing the securities industry, insurance, banking, all these different products, and they're all fighting to talk about themselves and talk about who they are. And then in mortgages, you have different players. And so the main reason CHLA was formed is we wanted to make sure there was an organization that exclusively represented IMBs. And since we've done that, we've gone, now we're like over 80% of the market. And so, but we try to get out there and educate people about why IMBs are important, knock down myths. People are always running around saying we're going to, devastate the market because we're unsafe. And then, fight for issues from a particularly distinct IMB perspective. But we don't kid ourselves. There's a lot of competition out there for attention. And so we need everyone to, talk to their own members of Congress. We need everyone to not everyone to have their own talk show like you do, but, more of that. That's helpful. That's really helpful.
So in reading through some of the notes here, there's a line in here that IMB originators face SAFE Act testing and licensing. Bank originators are exempt. Are you looking to do something about that? Are you looking to level that up in some way?
We think it should be. We don't understand why they can't just be required to take the SAFE Act test. I mean, there's thousands of banks, there's thousands of loan originators that work for banks that fail the SAFE Act test, and they're allowed to be registered. Go figure.
Well, they're also allowed, LOs at banks. It's my understanding they can have terrible credit too. You can't if you're an IMB.
Well, we don't think, we want to move in the other direction on that. We don't think that credit should be a basis for getting a license. Having some, healthcare problem in the past should be.
Well, the argument is, if you can't take care of your own credit, how are you going to advise other people to do that with the biggest decision of their life? That would be what the pundits would respond with.
Okay, well, I'm not sure I agree with that, but it should be a level playing field. That's our point. It should be a level playing field. It's just hard though, because the fiction is that these banks never have problems. Well,
yeah. Let's talk about condos.
Yep.
I mean, this is I'm not sure that all the numbers have worked their way through the system. They probably have not, but limited review is gone. Reserves have gone from 10 to 15%. What do you feel like the ramifications are going to be? When will we feel it? And what do you want to do about it?
Well, that's the problem is, it won't be that readily apparent to people on the outside. So we need to speak up about the impact this is having. So we've been out in front on this for a long time. I mean, they did some good things earlier this summer with insurance requirements, a little more flexibility on replacement cost and so on. But the limited review is a big deal for us. We think the complaints are going to escalate as time goes on. We're searching for some sort of compromise. I mean, they're saying that it shouldn't be no review. We're saying that maybe we can streamline. We're trying to figure that one out and see whether we can come back with a compromise on the replacement reserves. That's a big deal, and that's going to play out over the next year. We've been working closely with the Community Associations Institute, which is the top group representing condo owners. We kind of leave that issue to them, but we think this is going to mean that the dues at these condo associations are going to go up. It's going to make it hard to qualify for a loan. So we're trying to keep this issue on the front burner, and we're not afraid. We spearheaded a letter with CAI, with the mortgage brokers in July, saying that they should revisit these issues.
Do you have any sense as to what drove this?
I mean, it starts with Surfside. I mean, it starts with Surfside, which was, a regional thing where, a pool flooded the place and collapsed the building. But since then, I think Fannie and Freddie have done a deep dive on saying we're not sure we understand what's going on. There's like 50,000 associations across the country. It's hard to get a handle on, which ones are well managed and which ones aren't. So policies, the right level of oversight is hard.
Yeah, I mean, like we do a lot of condos here at NFM. We have our own condo desk and condo reviews and all that stuff. And our limited reviews performed better than our full reviews.
Yeah.
So wouldn't that be a smart place to start? Hey, what's performing and what's not?
That's absolutely. The other thing, and we're criticizing Fannie and Freddie, but, in some ways, FHA is even more restrictive. And so we called a year or two ago, we were asking them, why don't you, if Fannie or Freddie have approved a project, why don't you make a loan against it? Why do we have all these different agencies, different processes that are so distinct? So this is a big issue, and we're going to keep talking about it.
Have we left anything on the table here? Anything else you want to talk about before I bid you adieu?
I don't think so. Just you were talking about the, breaking through the noise. I mean, we've been trying to do that. Last week, we wrote a letter, going back on the, you just sort of, it's like Sisyphus pushing something up a hill on some of these. We're saying that IMBs should be eligible for federal home loan advances, but at a minimum.
Let's talk about that. Yeah, I'm sorry. I meant to bring that up. What is that?
So
explain that. What is it, and why should the industry care?
The Federal Home Loan Bank is the sort of the hidden GSE. No one focuses on them. They make advances, collateralized advances to banks for the mortgages. Well, basically, banks aren't doing mortgages anymore. So what we've said is, and this goes back to the Ginnie issue, is why not create a collateralized project that's funded by the Federal Home Loan Banks, and they funnel them through the banks. The banks do the underwriting, but they do collateralized advances to help with Ginnie advances. We just think that the Federal Home Loan Bank should be more focused on where the mortgages are being made, which is non-banks. So that, anyway.
And how will that help IMBs?
Because we'll get more credit and more liquidity into the system.
Will it add product or just more capital?
Just more capital, yeah,
Got
and
it.
more financing.
So how old were you when you first stepped foot into the Capitol?
But then you're going to be able to figure out how old I am. No, I'm not going to go there. I'm
not going to ask for the year.
I'm refusing to answer. It was 30 years ago, 33 years ago, I started working.
So you first stepped foot in the Capitol 33 years ago. So
no,
who is the most?
I lied. 34 years ago.
Who's the most famous politician you've met through your Capitol Hill days?
Bill Clinton, I guess.
What was he like?
He was smooth.
I'll say.
But he just turned 80. I went to the memorial service on the Hill for Barney Frank a couple weeks ago, and he showed up and made a speech. He's aging, but he still kind of got it.
He still got it.
Yeah.
Are you a historian?
My father was a history professor at the University of Wisconsin-Milwaukee. Why?
And you went to Stanford, right?
Yeah. Yeah. Oh, you've done your work.
That's a pretty good school, I hear.
But I think history is, nothing ever is really new. I mean, we had the S&L crisis in the 80s into the early 90s. And a lot of these lessons, the Silicon Valley Bank, it was just the S&L crisis revisited in a different form 40 years later. A lot of this stuff just keeps repeating itself.
Yeah, well, you wonder what is going to be the next crisis. I feel like we're sitting right there right now.
You sound like you've done a lot more work than a lot of people in figuring that out.
I think we're sitting. I mean, there's this thing, Misery on the Eights. Stan Middleman wrote about it in his biography, which was released last year, Seeing Around Corners.
Yeah.
And historically, if you look at the last 3 decades or so, there has been something not good that has happened around the eights. You mentioned 2008 and the financial crisis, 2018, COVID started to percolate. And, this 2028, there's going to be a reversal of home values. I'm telling you right now. So and we're going to go into a recession and rates are going to go down and it's going to start the refi cycle. And that's what is going to happen. I know I'm saying it as if I've seen it already, but look, you're talking about history. That's history.
Well, my only take is, and this is me talking, not Claude, that the one of the big problems is that they're throwing so much money at AI, and a lot of this is private capital through private equity funding. And what happens if that implodes? I mean, when are the profits going to come? Is there going to be we see this in a lot of new burgeoning technologies. You can have a bubble, and then
I think that's just going to accelerate unemployment, right? If it turns out to be something real, I mean, either way, we're hosed. If it turns out to be something really great, then it's going to replace a lot of jobs. The unemployment rate is going to go up. If it turns out to be a complete bust, all these big tech companies are going to go belly up or whatever. They're going to have a lot of distress. That's going to impact people's 401ks, their confidence. It's going to erode their net worth. Like none of those scenarios are good. It just feels like we've been spinning around in this cocoon of shit for 4 or 5 years, and eventually just the bottom's going to fall out. And my prediction is that bottom is going to be a pretty severe recession, and that people are going to stop making their payments on their mortgages. I mean, I'm already getting reports from a lot of people in the mortgage business that are making loans every day, Scott. This is something for you to track, that there are more and more people calling up their loan officers saying, I'm desperate, help me. Can you do a cash out loan for me? And there's also reportedly, at least in my circles, a record number of people that are making their mortgage payments later and later in the month. So they're going past their grace period of the 15th. Many people are now making them on the 22nd, the 23rd, the 24th, where they're not quite 30 days late. So it's not going to show up. But you're right on the precipice of them having to make a very serious decision. You know,
Well,
is it
and
is
I
it food
heard,
on my table? Is it gas in my tank? Is it my mortgage payment?
well, I heard the other day that credit card debt is what, up 60% in
Oh,
whatever,
it's all-time record. It's
5 years.
well over a trillion.
And
Yeah,
so,
well over $1
so,
trillion.
you know, and that's, there's a lot of people over the years that have said that the simple, you know, underwriting criteria, that there's more inclusive ways of measuring this. But obviously, if people are stressed by, you know, growing debt, and, you know, same thing with auto loans. It's like everyone, they're talking about now 7-year loans. You're talking about, you know, prices are at unprecedented levels for cars. So people are carrying a lot of debt. Obviously, the last thing they want to do is default on their mortgage. But at a certain point, like you say, what can they do? So,
Should be
you'll have me
interesting. Well,
back.
that
Will you have me back for another interview when some of the stuff that you're saying comes about?
yeah, of course. I love having you on here. You went to Stanford. How could I not have you on? I barely made it through Maryland. I'm surprised you even talked to me. I'm so dumb. You're obviously very smart. So you know, I'm usually intimidated when I talk to people from Harvard, Stanford, you know, the Ivies. But you have a way of
Right.
putting everyone at ease. I don't feel like you're judging me intellectually. So
Okay.
thank you for that. I appreciate that. Give me a quick thought on the deficit reaching $40 trillion.
Well, I just, you know, I went to business school, and everything they taught me was a bunch of lies when they said, well, at a certain point, you borrow so much money, rates have to go through the roof. And maybe that's starting to happen, but we gotta fix Social Security. I mean, it's 6 years away from, you know, running out of money, and and neither party cares about the deficit. The Republicans think you should just keep cutting taxes, and the Democrats think you should just keep spending money. And uh, so I don't know. That's, you know, the only thing that's gonna change that is when foreign investors start saying no mas.
Yeah, exactly. Or you know, when the yen capitulates, or
Yeah.
you know, all these foreign entities just take all their money out of our treasuries. There's a lot going on for sure. Scott Olson, executive director of CHLA, Community Home Lenders of America. I am a proud member. This is a great trade group to be a part of.
Thank you.
Not expensive either, and you get a seat at the table. I can speak to that. Every Tuesday at noon, we all sit around and everyone has a voice. Very impactful. Thank you for the work you're doing and for your time here on One on One.
As always, great to be on.
All right. See you again next Monday, everyone. So long. Have a great week.